Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Homeowner. Today, we're diving into some critical developments in the real estate market that could impact homeowners, potential buyers, and the broader economy. Let's kick things off with the Bank of Canada's recent announcement that has everyone talking. Just this morning, the Bank of Canada surprised the market with a 50 basis point cut in its benchmark interest rate, bringing it down from 4.25% to 3.75%. This unexpected move has left many wondering how it will affect mortgages, real estate, inflation, and the broader Canadian economy. At first glance, a 50 basis point rate cut might seem like welcome news for borrowers, as it typically means lower borrowing costs. This could be beneficial for prospective homeowners and businesses looking for cheaper financing options. However, it's crucial to understand that such a significant rate cut might not signify economic strength. Instead, it could be a signal that the Bank of Canada is anticipating economic challenges ahead, possibly even a looming slowdown or recession in Canada. The Bank of Canada's recent monetary policy report, released alongside the rate cut, highlights shelter inflation as a primary contributor to Canada's inflation. While the lower rate might reduce borrowing costs, it also suggests an effort to stimulate a sluggish economy. Homeowners might find some relief in their monthly payments, but this could be offset by rising unemployment or weaker economic activity if a downturn materializes. Moreover, while the Bank of Canada has cut its interest rate, inflation remains a concern, partly due to mortgage renewals at higher rates. A significant portion of mortgages in Canada, approximately 60%, are set to renew in 2025 and 2026. These homeowners will have to contend with significantly higher payments compared to the era of ultra-low interest rates. This situation could indirectly contribute to inflation by reducing disposable income for other goods and services. It's important to note that the Bank of Canada doesn't directly control all mortgage rates. While it influences variable rates, fixed-rate mortgages, which are popular among Canadians, are more closely tied to bond yields. The bond market, especially the 5-year government bond, plays a crucial role in setting fixed mortgage rates. As of now, the bond market is pricing in fewer cuts in the future, partly due to the political landscape in the United States. The interplay between Canadian and U.S. monetary policy is significant, especially in light of the Bank of Canada's recent rate cut. The U.S. Federal Reserve's actions can heavily influence the North American economic landscape. If the Bank of Canada continues cutting rates while the Federal Reserve holds steady or raises rates, it could devalue the Canadian dollar against the US dollar, making imports more expensive and potentially driving up inflation in Canada. Interestingly, a mild recession could actually help manage inflation. Economic slowdowns typically reduce demand for goods and services, easing price pressures. Economists like CIBC's Benjamin Tal often highlight that recessions, though challenging, are sometimes necessary to restore balance in the economy and ensure long-term stability. The Bank of Canada might be willing to allow a controlled recession if it helps bring inflation closer to its target range. For those with variable rate mortgages, the 50 basis point rate cut will bring some immediate relief, as their monthly payments will decrease slightly. However, fixed-rate mortgage holders might not see as much benefit right away, given the influence of bond yields on these rates. Additionally, with housing prices already elevated, the rate cut might not significantly boost homeownership, especially with the stress test still in place. In summary, the Bank of Canada's decision to cut interest rates presents both opportunities and challenges. While some mortgage holders will see immediate benefits, the broader economic implications, including potential recession risks and inflation concerns, mean that this rate cut isn't all good news. It's essential for realtors, homeowners, and prospective buyers to consider the larger economic context as they plan their financial futures. Today, we're turning our attention to a pressing issue affecting renters across Canada. As we delve into recent findings, it's clear that the rental market is facing significant challenges due to persistent supply issues. This is particularly evident in major cities where rents are forecasted to soar. Let's explore what's contributing to this situation and what the future might hold. According to a recent report titled AI-Driven Insights into Key Factors Influencing Canada's Rental Market, authored by Erkan Yunder in collaboration with the private equity real estate firm Equiton, the rental market's affordability is under immense pressure. The report highlights a troublesome supply and demand imbalance, largely driven by a rapid increase in immigration, which is exacerbating the situation in cities like Toronto and Vancouver. The data paints a stark picture. Canada's average housing supply per capita stands at 424 units per 1,000 residents, the lowest among G7 nations. Without a coordinated effort to address this supply issue, the affordability crunch is expected to worsen. Aaron Pittman, Senior Vice President at Equiton, stresses the need for granular, region-specific solutions to tackle this coast-to-coast challenge effectively. The report uses advanced artificial intelligence models to analyze a wide range of data, including census subdivision and mortgage information, rent, vacancy, and completions data, as well as immigration and demographic statistics. The findings suggest that if supply does not drastically improve, rents in Toronto could reach $4,100 by 2027 and $5,600 by 2032. In Vancouver, the situation appears even more dire, with projections of rents hitting $5,200 by 2027 and $7,150 by 2032. These projections are indeed striking, but not entirely unexpected. The rapid population growth, driven largely by immigration, has been a significant factor contributing to the supply and demand imbalance. In June 2023, Canada's population reached a historic milestone of 40 million, with much of this growth attributed to temporary and permanent immigration, according to Statistics Canada. The report also points to the vacancy rates, which are currently at record low levels. In a healthy market, vacancy rates should be around 5%, but they are now approaching just 1%. This high demand and low supply mean that any vacated rental unit is quickly occupied, further disconnecting economic factors from occupancy rates. To address these challenges, the report suggests that housing supply in Canada's major cities needs to increase by 6 to 10 times the current levels. The Canada Mortgage and Housing Corporation has echoed this urgency, projecting the need for at least 5.8 million new housing units by 2030, with 2.2 million of these being purpose-built rentals to improve affordability. Aaron Pittman argues that resolving this imbalance isn't solely the government's responsibility. The private sector plays a crucial role, providing nearly all of Canada's new housing stock. However, Pittman emphasizes that the government should facilitate an environment where developers and institutional investors can more easily contribute to increasing the housing supply. Equiton Developments, part of the real estate firm, is actively working on building urban multi-residential properties. By managing its own projects, Equiton can better control costs and timelines, allowing for more reliable and quicker completions. This approach also opens opportunities for everyday Canadians to invest in development projects, directly addressing the housing crisis. Ultimately, the report concludes that a one-size-fits-all solution is unlikely to be effective due to the unique challenges each market faces in terms of planning, approvals, demographic shifts, and housing infrastructure. A more regional approach is necessary to effectively address these issues. Pittman hopes that the insights from this report will encourage more coordinated efforts between private stakeholders and all levels of government to reduce barriers to housing where they're most needed. Solving the housing crisis may seem straightforward, but as anyone involved in the sector knows, it's a complex challenge. This research is aimed at unraveling that complexity and presenting data to the right decision makers. Our next story focuses on a troubling situation unfolding in Clearview, Ontario, where more than 100 homebuyers have found themselves facing significant financial losses. This comes after the developer of a pre-construction housing project, Sunrise Acquisitions, Stainer Incorporated, entered receivership, leaving buyers in a precarious position. The collapse of Sunrise Acquisitions has uncovered some risky practices within the company. Buyers were sold homes without the necessary legal approvals, a move that has now left them with little hope of recovering their investments. For example, Ryan Shahid, one of the affected buyers, had put down a $100,000 deposit for his first home with plans to move in by 2025. Those plans have now evaporated, along with his savings. Sunrise entered receivership back in February, and court documents reveal that homebuyers like Shahid, who paid substantial deposits, are unlikely to see their money returned. The company spent all the deposits, leaving it unable to refund buyers. Some individuals stand to lose as much as $130,000. It's a dire situation, and buyers are understandably demanding answers about where their money went, especially since no construction ever began at the site. The company's president, Hussein, admitted to selling homes in Clearview without securing the required legal approvals. He described this as a calculated risk the company had taken for years, a practice that had been in place for the last 15 to 20 years. This revelation has left many questioning the oversight in place to protect homebuyers. In fact, Sunrise Homes has a history of financial difficulties. The company has been involved in other failed projects, such as developments in Markham and Elm Vale, which also ended in receivership, leaving the builder owing millions. In the Markham case, Hussein and his partner, Muzammil Kodwavi, faced accusations of misappropriating millions of dollars and providing inaccurate financial records. The Ontario Superior Court of Justice even referred to the company's financial records as a cooked book. Despite these issues, Sunrise Homes remains licensed with the Home Construction Regulatory Authority, although the agency is now inspecting the developer's operations more closely. Bob Aaron, a Toronto real estate lawyer, is among those advocating for stronger protections for homebuyers and criticizing the lack of oversight. He questions why Tarion, the provincial warranty corporation, wasn't more proactive in stopping the marketing of homes that didn't have approvals. Tarion has acknowledged that Sunrise did not have the legal approvals required to sell or build the homes in Clearview. They noted that developers operating without approvals can face penalties, charges, and enforcement actions. A provincial spokesperson has emphasized Ontario's commitment to protecting consumers and mentioned plans to consult on proposals to address illegal building and selling practices. In October, a judge approved the sale of the Clearview Township property to one of Sunrise's lenders, Brexit Holdings. As part of this sale agreement, all purchase agreements with homebuyers were terminated, further dashing hopes of recovery for buyers like Shahid. While Hussein has expressed interest in repurchasing the land and restarting the project, many buyers remain skeptical of the developer's ability to deliver on such promises. Let's delve into the current state of the Ontario real estate market and what prospective homebuyers need to understand about property values. As we navigate through the fall market, it's clear that the recent interest rate cuts by the Bank of Canada are influencing the real estate landscape. With mortgage rates softening, many Ontarians are seizing the opportunity to enter or make moves within the housing market. However, it's crucial to grasp how these changes affect property values and the broader market dynamics. Recently, the federal government introduced new measures aimed at making homeownership more accessible. Starting December 15th, the cap on insured mortgages will rise to $1.5 million, up from $1 million. This change allows buyers to purchase a home with a smaller down payment, less than 20%, potentially opening doors for many who previously found themselves priced out of the market. But what does this mean for property values? Data from the Municipal Property Assessment Corporation, or MPAC, reveals a significant shift in Ontario's property landscape. Back in 2013, 74% of residential properties in Ontario were valued under $500,000, and 91% were under $750,000. Fast forward to today, and these figures have dropped to 19% and 48% respectively. This shift indicates that homes valued below these thresholds are becoming increasingly rare. Understanding the distinction between a property's sale price and its assessment value is crucial for both buyers and sellers. The sale price is the amount agreed upon by the buyer and seller, influenced by factors like urgency, personal preferences, and market dynamics. In contrast, the assessed value is an estimated worth determined through market data analysis. As of December 2023, the median home value in Ontario was reported at $756,000, according to MPAC. For those looking to understand their property's assessed value, MPAC provides a free tool called About My Property. This online resource allows homeowners to view how their property was assessed and compare it to others in their neighborhood. It's an invaluable tool for anyone looking to get a better grasp of their property's value within the current market context. In Ontario, property assessments for the nearly 5 million residential properties are determined using a method called mass appraisal. This approach values groups of properties at a fixed date using common data and standardized methods. MPAC takes into account over 200 factors, including location, lot size, total square footage, construction quality, and building age, adjusted for major renovations. Why does understanding property value matter so much? For many Ontarians, their home represents their single biggest asset. Knowing its value can significantly impact their financial decisions, from buying and selling to budgeting for property taxes. These assessments are not only critical for personal financial planning, but also for municipalities that rely on them to calculate property taxes necessary to build and sustain thriving communities. In summary, as the Ontario real estate market continues to evolve, staying informed about property values and market trends is more important than ever. Whether you're buying, selling, or simply holding onto your property, understanding these dynamics can help you make more informed decisions and anticipate future financial needs. Let's shift our focus to a fascinating development in the mortgage industry, particularly concerning the role of education and technology in empowering brokers. RMG Mortgages is at the forefront of this movement, as they leverage these tools to adapt to a changing market landscape. Bruno Valco, the Vice President of Sales at RMG Mortgages, has been a driving force behind this educational approach. He emphasizes that their business development managers, or BDMs, provide more than just rate sheets. They offer strategic insights and training to help brokers protect their business, garner more referrals, and outshine the competition. Valco's contribution includes regular economic updates that help brokers understand the bond market and its impact on interest rates. This knowledge is crucial for brokers to confidently answer client questions and offer informed advice. Valco highlights RMG's commitment to providing value beyond traditional sales tactics, fostering a reciprocal relationship with brokers who, in turn, bring business to RMG. RMG Mortgages also stands out for its technological advancements. The Gateway Broker Portal and MyRMG Homeowner Portal are state-of-the-art systems designed to enhance the experience for both brokers and homeowners. Each broker is paired with dedicated underwriters, supported by a strong broker relationship manager program, ensuring top-notch service. Valco advises brokers to understand the economic influences on the mortgage industry, enhance their knowledge of lenders and products, and market themselves aggressively. As Canada enters a phase where interest rates may decrease, brokers will play a crucial role in guiding clients through this transition. With a significant number of mortgages coming due next year, brokers have the opportunity to reach out to clients and offer valuable insights and options. In conclusion, RMG Mortgages exemplifies how a combination of education, technology, and strategic partnerships can empower brokers. As the market evolves, these elements will be vital for brokers to succeed and stand out in a competitive landscape. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found this information valuable as you navigate the ever-changing real estate landscape. Stay informed, stay proactive, and until next time, take care and keep making informed decisions.